Stocks and bonds are two common types of investments available in financial markets. Stocks, also known as shares or equities, represent ownership in a company. When you buy stocks, you become a shareholder and have a claim on the company's assets and earnings. Stockholders may benefit from capital appreciation if the stock price increases over time, and they may also receive dividends, which are a portion of the company's profits distributed to shareholders. However, stock prices can be volatile, and there is always the risk of losing money if the stock price decreases. Bonds, on the other hand, are debt instruments issued by governments, municipalities, or corporations. When you invest in bonds, you are essentially lending money to the issuer for a specific period. In return, the issuer pays you periodic interest payments, coupon payments, and returns the principal amount when the bond matures. Bonds are generally considered less risky than stocks because they offer a fixed income stream and are backed by the issuer's ability to repay the debt. However, bond prices may fluctuate based on changes in interest rates, credit ratings, and other factors. Investing in stocks and bonds can be an excellent way to grow your wealth over the long term. Here's a beginner's guide to help you get started. Educate yourself. Start by gaining a basic understanding of how the stock and bond markets work. Read books, articles, and online resources to learn about investment principles, terminology, and strategies. Take advantage of educational resources provided by reputable financial institutions or consider taking an introductory investment course. Set clear financial goals. Determine your investment objectives and time horizon. Clarifying your goals will help you make informed investment decisions. Assess risk tolerance. Understand your risk tolerance, which refers to your ability and willingness to endure fluctuations in the value of your investments. Stocks tend to be riskier but offer higher potential returns, while bonds are generally more stable but provide lower returns. Finding the right balance between stocks and bonds depends on your risk tolerance and investment goals. Establish an emergency fund. Before investing, it's crucial to have a financial safety net. Set aside an emergency fund that covers 3 to 6 months' worth of living expenses. This fund will provide a buffer in case of unexpected expenses or a temporary loss of income. Determine asset allocation. Asset allocation refers to the distribution of your investment portfolio between stocks, bonds, and potentially other asset classes. Your asset allocation should align with your risk tolerance, financial goals, and time horizon. A common rule of thumb is to subtract your age from 100 to determine the percentage of your portfolio that should be allocated to stocks, with the remainder allocated to bonds. Start with index funds or exchange-traded funds, ETFs. For beginners, a practical approach is to invest in index funds or ETFs. These funds pool money from multiple investors and aim to replicate the performance of a specific market index, such as the S&P 500. Index funds and ETFs offer diversification, low costs, and ease of buying and selling shares. Open an investment account. Choose a reputable brokerage firm or investment platform to open an investment account. Consider factors such as fees, account minimums, customer service, and the availability of investment options. Dollar cost averaging. Rather than investing a lump sum, consider using a strategy called dollar cost averaging. With this approach, you invest a fixed amount of money regularly regardless of market conditions. This strategy helps mitigate the impact of market volatility and allows you to buy more shares when prices are low and fewer shares when prices are high. Conduct research before investing in individual stocks or bonds. Evaluate the company's financial health, earnings, competitive position, and industry trends. Monitor and rebalance. Regularly review your investment portfolio to ensure it remains aligned with your goals and risk tolerance. Here are some reasons why you should consider investing in stocks and bonds. Potential for growth. Investing in stocks and bonds offers the potential for long-term growth and wealth accumulation. Diversification. Stocks and bonds have different risk and return characteristics. By diversifying your investment portfolio with a mix of stocks and bonds, you can reduce the overall risk. Income generation. Bonds are particularly attractive for income-oriented investors. They offer regular interest payments that can supplement your income or provide a consistent cash flow during retirement. Inflation protection. Stocks and, to a certain extent, bonds, have the potential to outpace inflation over the long term. Inflation erodes the purchasing power of money, so investing in assets that can provide returns higher than inflation helps preserve and grow your wealth. Portfolio customization. Stocks and bonds come in various types, sectors, and risk levels. This allows you to customize your investment portfolio according to your risk tolerance, financial goals, and time horizon. Access to companies and government projects. Investing in stocks allows you to become a partial owner of companies and participate in their growth and success. Bonds enable you to support government projects or provide funding to corporations, contributing to the functioning of economies and infrastructure development. Long-term planning and retirement. Investing in stocks and bonds can be a part of your long-term financial planning, including retirement savings. By starting early and consistently investing over time, you can take advantage of compounding returns and potentially build a substantial investment portfolio for the future. However, it's important to note that investing in stocks and bonds carries risks, and past performance is not indicative of future results. It is advisable to conduct thorough research, consider your risk tolerance, and consult with a financial advisor before making investment decisions. Thanks for watching.